Everyone, it's Mike Blind with Smart with Debt. Today, we're going to discuss what should a HELOC or home equity loan cost you. So, number one, it depends on a few things. First of all, it depends on where you're shopping. Are you going to your local bank, your national bank, or your credit union? That's going to make a big difference. You also have to look at your current credit score. Anything over 700 is typically a good score. Anything below that's going to cost you a little bit, either in rate, cost, and/or loan to value, how much they're going to give you. Next is your loan to value. How much are you borrowing against your property? Are you at a high loan to value, which means most of your equity is going to be used up by your first and your new HELOC or home equity loan? Are you at a low loan to value? So the bank has more protection. For instance, maybe you're at 80% loan to value, which is maybe a little bit higher, compared to 60%, which is lower. The lower the loan to value, the less it's going to cost you as far as rate and maybe even cost. So if you have a good lender, you have good credit, you have good loan to value, typically what you're going to find is it's going to cost you south of $500. Most really good credit unions, like here in Colorado, there's 3 or 4 that we love to use or recommend. But just like that in any state, just top lenders out there. And the majority of them are going to charge probably under a couple $100 to get this done. That includes the paperwork, the closing, the recording, even if there's some kind of valuation going on there. Now, if you don't have some of those, like good credit, good loan to value, it's going to cost you a little bit more. You may have to go through a broker or a non-conforming or non-traditional lender where you may pay up to $1,500 to $2,000 for closing costs instead of a couple $100, and also your rate. Good credit, you're going to be at prime, maybe prime plus a little bit. So just look at Google, check out where the prime rate is. Right now, it's right around 8%, but it just depends on when you watch this video where prime is. But if you have all of those things, you should be paying under a couple $100, and your rate should be right at prime. If you don't have, good credit or the loan to value is a little bit high, probably paying in, the 1,500 and 2,500, and you're going to look at prime plus anywhere from 2 to 4 points, which means your rate's going to be higher, means your payments are going to be higher, means you're going to be paying more for that debt. Now, if you're out there shopping, we have some great shopping guides. If you're in Colorado, we also have a list of the top lenders here, which means where you're going to pay the least, where you're going to get the best rate. Check out our website, smartwithdebt.com, and we'll catch you on the next video.